Thank you. Well, I wonder if maybe first of all we could start by introducing ourselves. Nick?
Right. Hi, my name is Nicholas Harper. I work at Janus, Henderson. I'm currently a portfolio manager, but my background is in quantitative risk.
Ian?
Hi, I'm Ian Paczek. I'm a portfolio manager at UBS Asset Management. I manage European and global equity portfolios. My background's as a physicist a long time ago.
And Johnny?
I'm definitely not a physicist. So my name is Johnny. I work in legal and general retirement. So my focus is to set the investment strategy to back the retirement annuity business.
Thanks very much. Well, let me start off by saying, first of all, welcome and thanks very much for coming along. I don't want to prejudice the panel, but I'd really like to make this active rather than passive. So if you have any questions, you have any comments, please shout as we're going along, and we'll try and get a dialogue going. We will have Q&A at the end, but it'd be good if we could get some interaction going. I guess if you look at the ETF market, if we think of that as a synecdoche for passive investment, you could be forgiven for thinking that the argument's already been won. I was glancing at the FT this morning. In 2008, according to the article I read there, ETFs were about 700 billion in total value. They are now 4.4 trillion. That's about, again, according to that article, about 4 times the value of actively managed funds. So it does seem that the market has lurched over the last 8-9 years towards the passive strategies over the active strategies. But I thought it might make sense to just start by taking a step back and asking if we really feel or if we really know what the clear distinction is between active management and passive investing. Johnny, any thoughts on that?
I think it's interesting to define what traditionally means by active and passive now. I think from what I can see from an insurance sector or like a pension fund sector, I think this active versus passive getting a little bit more and more mixed with each other, because I think back in the day probably you're probably thinking about that there is you mimic a particular index, and then now basically the active side probably is simply just say a target return or like a certain target. But I think I speak on my behalf basically is there are more and more for insurance sector, the people who actually looking at the investment return and the way they think about investment is really driven by potentially the business they're running and then the capital usage, and also it's more like a balance sheet focus instead of actually just simply saying that I want to generate a certain return. So I think that definitely there's a development on the certain sector. When they talk about active versus passive. For example, myself, basically, when I'm looking at, even though as an insurance strategy, investment strategy, we're looking more like a buy and maintain type. So traditionally, it's more like just a passive focus. But now, basically, because we want to actually also quite actively try to see how we can actually optimize from our capital position. So that's why the alpha actually does start coming in, and then we want to actually also have a high return on the capital as well that we put into the business. So there's like a kind of a mix between the active and passive.
Nick, would you draw a clear distinction between the two?
I mean, for me, there are a lot of different definitions that you could use. I mean, passive is normally tracking an index, but I think probably the most material one from a client perspective is the fees. You look at what passives charge, it's significantly below active, and I think what you're beginning to see is potentially more fee pressure in the active space, and you're beginning to see a lot of things that would have 10 years ago, 20 years ago been an active strategy that would have been charged quite heavily for being adopted in the passive space. I think one of the anecdotes that I think has been mentioned before is in BlackRock, with their scientific equity team, they will run a strategy as an active, and then when it stops being an alpha factor, they'll relaunch it as a passive beta strategy. And I see that trend continuing. So I would imagine in sort of 10 or 20 years' time, the range of passive or low fee strategies that you will have will be much bigger than we have at the moment, and potentially will incorporate a lot of really quite exotic strategies that are thoroughly in the realm of active. And I really kind of see it as essentially active is a pioneering field, and then passive is kind of going up behind, taking some of the simpler stuff, packaging it up and making it cheaper.
Ian, any thoughts on
Yeah, I wouldn't disagree with that. I mean, that's certainly a commoditization of what's been out there and has been tested. And but I do think that the boundaries between active and passive are somewhat blurred. I mean, you have an enhanced index strategy that could look a lot like a very relaxed kind of passive. You could take the extreme view and say that nothing's truly passive unless it's completely full replication of whatever index. Even I would point out that Kramer's and Petehisto's active share is not a panacea. You can have global funds that don't have a terribly high tracking error, such as sub 2%, and yet they have an active share in the region of 70 to 80. Whereas if you take a very concentrated single country in Europe, Switzerland perhaps, or Finland, and you try and run a fund with a high active share, you're going to generate a very high tracking error because of the large amount of dead weight that sits in some of those very, very large names, those large index names that dominate those small and concentrated indexes. So I think it's a difficult question, and it's a difficult distinction to draw with any clarity.
The distinction I would draw actually is a semantic one between passivity and neutrality, because I really think those are absolutely not the same thing. You can be in a passive fund that's investing on a market cap basis, but the reality is, as the market, for instance, tech stocks, as the market cap of those stocks grows, so they will attract more passive investments, so their market cap will grow, so their weighting will grow, and you end up with a situation, for instance, with the S&P 500, where 20% of it is basically a very small number of companies, and they end up dominating the strategy. So it's far from neutral. You actually lose diversification. Even in so-called smart beta strategies, I know that covers a multitude of sins. That's there as well. I mean, if you pursue a strategy that is weighted more, say, on dividends than on market cap, that can build up a presence in dividend-paying stocks that are very interest rate sensitive, and you can end up with an anything but neutral selection on the back of it that will deliver some very surprising results over time. So I think that's an important distinction to make. One thing we slightly digressed onto there that I'd like to come into maybe in a little bit more depth earlier than I intended, is the issue of fees. For the active investors amongst us, and sorry for springing this on you, how have you seen your fee structures develop? Ian or Nick or Drive, anyone wants to launch in on that one? I caught people on the hop there.
I mean, I would say performance fees are probably becoming more common than they would have been beforehand, because people expect, if you're paying for active management, to generate returns in excess of benchmark. I wouldn't say there's been necessarily that much change in the fees, but I would say there's a lot more competition in the active space than there has been. And I think there's a lot of strategies that 10, 20 years ago would have been quite competitive that in today's market struggle a bit more. But generally, there is definitely a distinction between sort of some of the higher quality active managers and passive. And for those guys, they have and always will be able to charge a decent fee, because what they're delivering is performance in excess of benchmark and indeed in excess of passive products.
Any other thoughts on that?
Yes, I mean, I'd agree with those points. I don't. I mean, fee structures change from time to time, but I'm not sure I've seen any sort of secular trend over the last 10 or even 20 years that I could really point to. I mean, 10 years ago, I had some long-only funds that had performance fees, and now I don't, so it's gone the other way for me.
Right. Johnny, any observations on that?
I think, I think for me basically is there is quite a distinctive between service versus performance now. Especially like as some people consider for myself basically like we probably expecting a lot of like a so-called performance now drop into like a more like a service fee base and then like as a fixed cost. And then that will I think and then also I think that the competition definitely I think is higher. I think like you can see more and more people that come in and they provide a lot more like a broad services and then trying to compete on that space and then like trying to move away we actually like reduce the exposure to the performance side and then move into the service side.
Just out of interest, for those of you that are invested in active strategies, who would say over the last 4 to 5 years they've seen their fees come down? Someone must. What about a movement from management fee to performance fee? I think that's one thing that we've been seeing some of recently. It is a very, for us, it's been a very national, nation by nation trend. I think the Americans particularly have been very, very aggressive on moving away from management fees towards alpha generation, basing fees on that, and even in some cases insisting that any management fee that you take, you actually recoup out of performance fees later on. So it really does move in that direction. But for us, at least, that seems to be the pressure that we've witnessed, albeit as said, it differs from country to country. Coming back onto the impact of passive funds, particularly ETFs, should we be worried, Nick, about the momentum effect that they seem to be having?
I mean, so I think when you look at where we stand today, there is obviously a very attractive case for passive, and I think a lot of that is partially driven by this momentum effect. I mean, people have been buying passives, and there's a phrase, you can buy your own performance. I think to some degree, if you've got passive indices, there's big inflows, and they're going into the stuff that passive indices buy, so it's going to push the performance even further. The other thing as well is that's against the backdrop of quantitative easing, where what's happened is you've had this flood of liquidity coming into markets, and people have been buying securities fairly indiscriminately. I mean, so one of the phenomena that we're seeing, certainly in the active space, is just that level of dispersion in stock returns is so much lower than it would have been if you could look back 10, 15, 20 years. And the interesting thing is, this has been the trend for 10 years, pretty much non-stop. And I think there are risks when that begins to diverge, because it is, fundamentally one of the parts about markets, they are supposed to allocate capital efficiently. When you have fairly indiscriminate buying just on the basis of something like size, there is a risk that you get very large disjoints in sort of things like valuations, and you end up with capital being allocated in the wrong places. And I think you won't necessarily notice that whilst, those inflows are carrying on, but it could be when you see the turning point, there is quite a significant impact. And also, if you have a turning point, lots of inflows into passive, if there start being outflows, it will be the stuff that the passive buys that will go down. So you could see a bit of a reflexive cycle there. And in that case, I think you could end up seeing active managers having a bit of a resurgence, and passive, still being a big force in markets, which I think passive is definitely here to stay, and it will always be a big part. But it may be, would either shrink, or you might begin to see a better performance coming through in the active space than you are at the moment.
If we think that passive strategies are leading to a degree of herding, Ian, do you have any thoughts on that in terms of what that implies for market efficiency?
Yeah. Oh, sorry, I've got my phone, my microphone switched off. Yeah, I think that obviously passive strategies do create predictable opportunities. When something goes into an index, ahead of time the index provider makes the announcement that stock is going in, but the passive strategy won't trade it until the day that it actually goes in. So there is that period between announcement and trade, or announcement and actual effective date of the entry to the index, during which time an active manager can come along and pick up that stock for less than it's going to trade at on the day that it goes in. So those opportunities, I think, do exist, but it's whether you can make enough money from them, whether you can consistently exploit them, whether you can put enough into those kinds of strategies. And even the current level of passive funds, I think we're a long way from any sort of active nirvana where we just walk down the street and pick up random amounts of money that have just been left lying around by the passive guys.
So you actually, sorry, just to pick up on that point, what you're saying is we're far from reaching a point, so to speak, of peak passivity. You think it can actually go further? Yeah.
Certainly from the point of view of the active managers arbitraging away the any of those index entry and index exit opportunities. I think that there's not enough money to be made in those for it to really cause a lot of pressure on passive at the moment, certainly.
How about the other panelists? I mean, do you think we're at a peak level of passive investment, or do you think it can go further? Johnny, any thoughts?
I think people are moving more into the active though, because I suppose it's the yield is actually very low. I think in the fixed income space, especially on the credit side. I don't know whether you agree with me, but like the spread and all this compression and things like that. Yeah, so I think like there's obviously it's like everyone's trying to actually find that extra bit of the alpha in order to generate the extra return, basically, because just the rate is low, the spread is basically like kind of back to like 2006 level, 2005 level. High yield basically like high yield index probably like you're talking about like a 200 or whatever spread, basically 230 on the double B area. So it's getting to a point basically like I think people are actually more looking into the active side. So
I think one of the issues we see with that is the impact. Is there sufficient liquidity in some of the underlying in these passive structures to actually satisfy the liquidity on the other side if people wanted to get out in a hurry? For instance, if we look at something like high yield bonds and the ETFs and the passive funds that have those, we've seen a situation in the States where there's been a huge issuance since the global financial crisis as a result of quantitative easing. But at the same time, the risk-weighted capital requirements that were placed on the banks as a result of that mean that it really isn't economically viable for them to hold large inventories of bonds for secondary market trading. At the same time, a lot of the money that's come in through the passive structures is quite fickle money. It's not like the old life assurance money, it's not like the pension money, it's not sticky. And our fear is that if you were to see a surge in interest rates from here for whatever reason, or some kind of distress, you could actually see a rout. You could actually see people trying to get out of these passive structures, but find that the underlying liquidity is maybe not sufficient. That's a concern that we certainly have. Just moving on from there slightly, I mean, when we're talking about passive and active strategies, should we make a distinction about the value of passive and the value of active, depending on the nature of the investor? Johnny, any thoughts on that?
yeah, I think this is because on the insurance sector, basically we do a lot of alpha strategy more on the illiquid assets. So I think especially on the real asset, property asset and all this stuff. So I think we definitely see we should put the value of the passive, even though it's passive, because it's a real asset basically buying, and then basically you do a lot more so-called active component. I would say like on the initial origination, you have the underlying due diligence and all this stuff that you go through it properly, and then you are actually kind of holding on and buying, and then obviously you work out a lot of exit strategy if certain scenario goes here and there. Those kind of value is like I think is even though it seems like it's a passive investment, but it's actually there's an active value into it.
Ian, any thoughts on that in terms of appropriateness for the investor base?
Yeah, I think what investors really want is absolute returns, because they want to grow their wealth, and what managers want is to be measured on relative returns, because they want to say, well, you've got to be fair, you've given this mandate, you've given all these restrictions around it, and therefore you've got to compare me to whatever the conditions were. So there's a disconnect there, and if you have a larger initial wealth, obviously you can withstand more volatility, and so does that argue for passive, or does that argue for, well, it argues for passive in terms of relative returns for investors with less initial wealth, because they might as well just buy the market, especially if they don't have a lot of specialist information. But in terms of absolute return, buying the market, they've got to be able to ride out the ups and downs of the market. So maybe what they really need is something that's more defensive than the market, and then maybe that argues for min vol, which is passive, or maybe it argues for something that's a more active but defensive take on that thing.
It kind of feeds into the issue of are passive or active strategies appropriate for the market timing? I mean, certainly we've been investing in leverage credit now for a long time, and I'll freely admit for the last few years it's been relatively easy, in as much as default cycles have been very muted. We haven't seen a lot of negative migration in credit, so it's been a good time to be passive. But by the same measure, if we had been passive in 2008, 2009, we'd have taken an awful lot of pain when the default cycle peaked. So, I mean, is there? I guess what I'm coming to is it? Should we change passive versus active depending on where we are in the cycle?
So my feeling is, and I think there is also quite a lot of evidence to support what Duncan is saying. What you tend to see with active managers in a raging bull market like we've been in for the past 5 years. It is very hard for an active manager to outperform an index, because you have these larger stocks in the index that are hitting the lights out. You look in the S&P, you have your FANGs, and they've been driving a lot of the performance. And the kind of smaller, more idiosyncratic part of the market where you tend to get the active managers playing has not performed as well. But at market turning points, that the parts of the market that you're in and that idiosyncratic stuff becomes increasingly more important, and the span of the opportunity set becomes much, much bigger. And that's particularly true as well in the fixed income space. In the fixed income space, when you look at valuations at the moment, for bonds with really quite radically different risk profiles, you can be getting only very small premiums in terms of spread. And at some point, active management has to add value there, because an active manager can look at those securities and say, okay, we're not being adequately compensated for the risk. And for a while, they will probably be wrong. When everything goes up, when you have liquidity being abundant in markets, active managers will not be correct. But at some point, that trade will turn, and then that's really when you want to have an active manager who knows the intrinsic worth of the security and has a more structured process around valuing and assessing risk.
So we've talked about the investor, we've talked about the cycle in terms of which is appropriate out of passive and active strategies. What about the investment itself? Are some strategies better suited to passive investment? Sorry, some asset classes better suited to passive investment versus active? Ian?
Well, just to go back to one of Nick's points earlier that you know, when all when the whole market is trending upwards in one direction, yes, when it's all trending upwards together or equally trending downwards, and there's very little to distinguish, then you might as well just buy the market, because you're not getting a lot of. It's difficult to make much of a distinction between individual securities, but when cross correlations are lower, then that's when active managers should really be able to make a distinction between those investments that are worth more and those investments that are worth less, whether they're looking through some sort of valuation lens or growth lens. And I think I strayed off the question, haven't I?
No, not really.
No. Oh, okay. And so I think that it's. I would say that the active opportunities are more a function of what the market is doing rather than where the market is, where it's heading, and how the securities are moving together or not moving together. That's what creates those opportunities, and otherwise, you so it's more a sort of, yes, I agree. There's more of a there's times to be in active and times to be in passive, but the problem is that just like the argument of being fully invested, or that the time that you're not fully invested, when you pull out of the market and sink everything into cash, is the time that the market turns and you miss out. So by being fully invested, you guarantee that you won't miss out, and by sticking with an active strategy or a passive strategy, you will benefit from whichever you decide is the one that is appropriate. But by switching between the two, unless you have some degree of information over that, then it's like timing the market. Timing active versus passive is difficult.
Johnny, in terms of asset classes, do you see passive strategies or active strategies as being appropriate for specific asset classes?
Can you repeat the question?
Yeah, I mean, in terms of passive or active approaches, are there specific asset classes or investments that favour one over the other, where one over the other is more appropriate?
I think for the active strategy, I definitely favor I think you go back into from my perspective, is the liquidity of the asset classes. Mm-hmm. I think for active, I think is much easier or much better suited for the liquid assets, mm-hmm. and because you kind of have a transferable price and all this stuff is quite obviously sometimes actually we know that the market will dry up. But then on the passive side is more on the illiquid assets. So that's what I think is I think what Ian just mentioned is quite good. Is in terms of market timing, is also like the determining of your whole portfolio. So you cannot sometimes actually it's very hard for us to actually completely saying that, you know what, let's put in cash and then don't invest. But and then at the same time is what are you going to invest in during the kind of long carry phase? I think those times basically we should actually have a clear concept about how much liquidity that you want to see in the portfolio, mm-hmm. so that when things to get to the point actually you acceptable level of your carry target, and then when the market turns and then you have enough liquid asset, you could turn around and take the opportunity.
Okay. Let me just take a very brief pause there. Any questions at this point from the audience at all? Yeah.
Quick question for John Chow. Actually, could ask a similar question to Ms. Harper. So Chow, if I understand properly, you mentioned that if you have a difference between active and passive strategy depends on the liquidity itself, whether it's a liquid or in the liquid market. I'd like to take the question a bit further. Have you tried finding an indicator of liquidity that you could use, a specific threshold that says that beyond or above a certain value, you switch to active management rather than passive? Is it quantifiable? And in a similar way to Mr. Harper, you mentioned raging bull market. Obviously, here it's very difficult to be active. You mentioned the other extreme security market where it's quite the opposite. There again, do you have any specific indicator or threshold that you could give us?
So in terms of an indicator of market level, so for me, that wasn't necessarily it's not necessarily for me something that you can time. I mean, I'm not somebody that can go out and say the S&P is going to do this tomorrow. I'm talking more broadly that over time, if you own active, you will tend to do better in the periods of market stress and where you have very wide levels of stock dispersion. Timing, that's another issue. So I wouldn't necessarily be creating rules and saying, okay, I think the market's going to go down, I'm going to move into passive. If I was doing that, you'd probably be better off just going short the index rather than moving into active management. But as a rule, I would prefer, and I think there is quite a lot of good evidence to support this, you know, if in the longer term you're worried about how much capital you could lose in the down periods, then potentially active is a good solution to that. And also, there are certainly a lot of active products that would definitely play into that market that give you a slightly different proposition to some of the ETFs. The ETFs, as Duncan mentioned, you have the crowding. So things like min-vol, yeah, okay, you know, it is supposedly a defensive strategy, but when everybody's piled into that, you know, there are still very big inherent risks. And it's actually one of the interesting things about min-vol is if you look at some of the min-vol ETFs, you might be surprised actually to see that when you look at the realized vol, it can actually exceed the vol of the underlying index, because in periods where people sort of reflect and you get big reversals in quality and you get big reversals in that kind of min-vol phenomenon, you know, volatility really does go up. With an active manager, because their stuff doesn't overlap as much with other market participants, you kind of avoid some of those risks that would be very prominent in the passive space. So I'm not necessarily saying you can time it. What I'm saying is that, you know, given the choice, if I was worried about the down periods, I would probably be more likely to go active than I would be to go passive.
Johnny, is there a liquidity measure that you could cite or a threshold for it?
So I think that was quite an interesting debate for like a few years ago, back in a few years ago, and then when people start actually moving from when the spread and all this stuff become low, and then like try to actually like get a little bit more extra income, and then like then everybody was talking about let's go into the real asset and liquidity. So the way I would put it, because I'm a kind of like a credit portfolio person, so in a sense it's like I try to link the liquidity into something quantifiable, which is like if you cannot actually go, if there's a migration to happen throughout a certain period of time, then you can't actually like get out with basically you could look at like you could look at it from a historical level, basically what's the migration look like for a particular bond or like index or whatever, like whatever sectors, right? And then like at the same time, basically you could also like look at historically what could actually happen on the spread. So obviously on the corporate bond side, basically assume there's always a price. You could actually stress the spread a little bit. But then like for the illiquid stuff, meaning actually like even though assume actually like you cannot actually sell it, then you could actually see actually how much of the capital is actually you're depleting and then increasing on your balance sheet. And then that could be actually the way that I set my liquid asset appetite. How much do I want?
So if I understand you correctly, use something like the liquidity value adjustment of your portfolio, for instance, and you do some back testing with the pounds.
Yeah. So you set your appetite, and then also at the same time, I think for individual investment perspective, then you could always argue, because like what is the saying, normal, say similar maturity, similar sector, similar like names, basically is like yielding you like say 100 basis point over, and then like this one say illiquid is like 120. Then the question is actually whether the 20 basis point for the certain period of time is enough to cover that the inability to liquidate, and then you're happy to actually warehouse that. I think that is actually the way that we think about the liquid premium.
Sorry, could I? Yeah, I was going to add. The question of liquidity is quite an interesting one because it reminds me of a few years ago. It was nearly 10 years ago, I guess now, when Volkswagen had its short squeeze, and I know that I believe a number of passive managers who weren't full replication had decided to buy the preference shares because of their liquidity, and they got quite badly caught out when Volkswagen ordinaries spiked up and Volkswagen preference didn't follow them, and then that liquidity shock was something that started to make some passive managers look quite active, really.
Any other questions from the audience at this point? Sorry, yes.
How important is the overall asset allocation, and can that be done passively, or do active managers have an advantage there?
Anyone would like to take that?
So yeah, working in multi-assets, I'll probably take that. So I think there is, well, I would have to say this, but I do think it's true. I do think there is a big role for active management, of passive products. You look at the span of passive products that people have access to now, it's not dissimilar to the span of equities you would have had access to 20, 30 years ago. And I think as that investment universe grows, the opportunity for active management in the allocation increases. And, sometimes that can be, just fitting things to whatever your client mandate is. So I think that's becoming increasingly common, as Johnny has talked about, kind of with that kind of integrated service. That's actually quite a complicated job because the opportunity set is very big. And I also think, you can now start playing in bits of the market and trying to time bits of the market that you just couldn't even dream of doing sort of 20 years ago. Things like Bitcoin, even things like commodity ETFs are becoming increasingly inefficient. And for somebody who's a multi-manager, it becomes actually a very exciting opportunity, I think, rather than a threat. Because, you can choose from a lot of stuff, you can pay a very small fee, and, generally these things have pretty good liquidity on a daily basis, at least at the moment. So, whilst there might be a case sort of going forward for some sort of multi-asset, for some multi-asset passive products, I really do think actually there's probably more opportunities just because you can't create a passive product for each client. You can't create a passive product that achieves objective X. It becomes too specific, really. I mean, a lot of my job would be managing things that are very specific. So you're trying to achieve, a risk target of X with a stable dividend, with low fees. You can do that passively, but the problem is you don't have that level of tailoring to different clients. You don't have the opportunity set to time, which can be a very good source of value over the longer term. And really, I think that's going to be an area that passives will probably struggle to penetrate much. Although I could see some of the simpler strategies, so say things like momentum. You are beginning to see multi-asset momentum ETFs. You are beginning to see multi-asset sort of carry trade values, that sort of stuff. I think that's definitely going to come. But then multi-asset managers can just allocate between those. So for every time you get people creating sort of multi-asset passive strategies, it also actually creates multi-asset allocation opportunities. So you can kind of sit there and see, okay, what are the passives, what are the options? And having the skill set to do that, I think, will become increasingly more valuable as the opportunity set widens.
Any thoughts on active versus passive asset allocation?
I think I agree with Nick because I think the multi-asset is definitely one thing actually really because it's very hard to define every single bit, and I think more and more clients, especially in this environment, is more wanting solutions, not so much about like specific detail. Basically, I tell you what my problem is, and then can you actually design within a certain kind of framework and then achieve that, and then to manage the risk at the same time the return on the ROE. So I think that's definitely, I can see that there's a trend, and then especially like also answering that gentleman is how, at what point do you think I have my appetite, but at what point do I actually want to see this is an opportunity, want to actually stay around, say 20% of my portfolio is illiquid, or like 80% is liquid, or I could actually switch around when I have more inflow of cash that comes in when the AUM grows as well. So I think that is is actually a solution problem, not so much a specific asset class problem.
The only thing I would add to that is, probably active upon active, where you have active at the asset allocation level and active at the constituent asset class level. You've got to be really sure that both levels of management are delivering, because that's a lot of fees that you're paying, and so it seems more likely that we'll see more of the active allocation with ETFs or passive allocation with active management below it.
I think we've got time for one last question, if there's one there.
Maybe I just if I could ask a
Yes, sorry,
question. So we've covered sort of a specific subject, but just while you're here, maybe if you have comments about what are the broader challenges to the industry and anything kind of topical, what you're finding the hardest.
Broadest challenges to the industry. Right. That's a good one.
Well, I think the amount of leverage in the financial system at the moment, and concurrently the very low level of rates and extraordinary valuations you're getting across pretty much all asset classes is potentially the biggest challenge. I mean, you wind back 20 years, you had far more value in the stock market, but you also had a lot more dispersion there as well. So you would have a big difference between the expensive stuff and the cheap stuff, and a big difference in terms of growth expectations. Now everything seems to sort of have narrowed, and I think trying to get those opportunities, they are still there, but I think it's much harder than it would have been.
I would agree. I think the dislocation of transmission mechanisms for risk and pricing within the market has pretty much broken down on the back of years and years of QE. And at some point, there has to be a day of reckoning for that. And that's why I firmly believe that going into the next few years, I think active management is probably the way to go. I think passive strategy will get caught in as the transmission mechanisms for risk re-establish themselves in a more normalised environment with a less accommodative monetary policy. So yeah, I'd agree. I think that's the biggie.
I think there's still a perception out there that the city finance professionals in general have not been good, and there's I think the profession has a lot to do still to communicate with the general population, the investing public, and show that we are a profession just like any other profession that should have high standards and can be trusted.
Johnny,
for me is turning from back in the day, basically turning from the leverage. Now it's going to the liquid premium. So it's like to watch how whether you're really being kind of compensated for the risk that you're taking, and also the opportunity to actually to explore new asset classes, to originate new assets for the balance sheet, basically.
Okay, thank you. I think how are we for time? Yeah, how are we for time? One more question, anybody? Yes.
I came across a research paper a couple of years ago which said that if you compare the active funds with passive funds over a very long period of time, then the extra alpha which is generated by the active funds is more than offset by the high fees charged by the active funds. I'm not sure if that fact is still true, or how long is that time for which this fact is true.
I mean, I would say what I would say about active management generally is, since active managers are a significant portion of the benchmark, on average, you have the fees taken out, you are going to struggle to beat benchmarks as a whole. The joy about active management, you have to be in the right manager. So you have to be in the right position, and you have to spend a lot of time and a lot of effort trying to find the best managers. Just going into an average active fund, I don't think is ever the right decision. It requires research, it requires finding the right managers, and it requires sticking with them for an extended period of time. I don't think you can necessarily make a case for any active manager, but what I would say is there's a very good case for some of them.
Johnny or Ian on that one?
Yeah, I mean, another paper is and a book by Lasse Pedersen about the markets for stocks, or the markets for assets. Sorry, I always think of stocks because I'm an equity investor, very blinkered. But the markets for assets and the markets for managers of assets are two markets that have their own. Neither one is fully efficient on its own, and they interact with each other. And it comes back to this idea of search costs to find a good manager who can deliver that outperformance on an ongoing basis. And there is a cost associated with finding that.
I completely agree. I think search costs are a factor in terms of can you actually afford to spend the time and invest the effort to find what is the right active manager? Because I think that's a key differentiating factor. I would say over time, the direction of fees does seem to be heading more towards a performance-based structure rather than just an ongoing structure, and that may go some way to addressing some of the general concern you expressed about effectively not being able to offset the gains from active management because of the fees.
I think the one more point potentially as well. There is also a social benefit from active management, because if everything was passive, you have completely random pricing of securities, and so whilst it might be that for an individual, you lose from investing in active manager A or B, overall the system works better if you have at least a fair chunk of active managers playing in the market, because it means that capital is getting allocated properly. With passive managers, you have no idea where the market's going to go, because they're just investing blindly on weight. So I do think actually socially there is a very big case for having a large chunk of the investment industry in active. So that's kind of external to whether you're an individual investor. And as I mentioned before, I do think there's a good case for many asset managers, and you maybe necessarily can't make the case for all of them. But I also, from a social perspective, think that actually having a lot of active management is beneficial, because it means your money's in the right place.
Picking up on Nick's point from the social perspective too, I think there are governance consequences to having an excessive passive management. Not to say that they don't engage with the stewards of the company the way they should, but they don't have the nuclear option of voting with their feet. And something we were discussing earlier before the panel. I think that's a key issue. I think that's it. So thank you very, very much, and thank you for all the questions. And please join me in thanking my co-panelists, Nick, Ian, and Johnny.